Welcome everyone to FX Street. It's 8:21 a.m. Eastern, January 30th. Today is what, Wednesday? Today's Wednesday, 2013. Welcome back. We apologize for the delay. We were just tightening up a little bit of our technology on our end, but we should be good to go. You should be able to hear my voice coming through the microphone loud and clear, and see the chart moving around, the mouse moving around the chart. Good to go. Okay, welcome everyone. In less than 9 minutes, we have one of the biggest numbers we've seen so far on the economic calendar this year. That is U.S. GDP, Gross Domestic Product. Last month's revision, it's actually a quarterly number that's revised every month. We get revisions every month. Last month's revision was 3.1% growth. Just to give you a general idea of what that means, we want to see at least 3% growth for the economy to keep pace with inflation, to keep pace with just the rate of employment as well. The expectations this month, that will be out in about 8 minutes from now, is 1.1%. That's anemic at best. A recession occurs when you have 2 consecutive quarters of negative real GDP. So if the GDP today, for whatever reason, is below zero, that would be 1 month's revisions. If we have 2 consecutive quarters of negative real GDP, that's officially a recession. However, in my opinion, it doesn't matter if we officially hit the recession or not. We all know what the economy is. We all know what the state of the economy is. We can feel it. At any rate, that's expected at 8:30 a.m. Eastern. And later on today, if I'm not mistaken, later on today, this week is a really, really big week as far as U.S. economic data is concerned. Been kind of quiet so far. U.S. GDP 8:30. And then, what was it, 12:15? 12:15, we have the FOMC, the Federal Open Market Committee interest rate decision. Of course, the Federal Reserve is expected to keep rates unchanged at 0 to 0.25%. However, as always, it's much more important what the Federal Reserve indicates in their statement or implies in their statements, whether they're more or less likely to take away monetary policy, which would be the first, quantitative easing, which would be the first step in a change in monetary policy. I'm sure all of you know that we've had 0% interest rates for many years now. That has not been enough. We've now seen multiple rounds of quantitative easing where the Federal Reserve has printed all of this massive new amounts of money and injected that into the economy in the form of bond purchases in order to stimulate growth. That in turn has led to a weaker dollar, which is what we're looking at on screen, the dollar Swiss daily charts, and it's led to stronger stock prices, higher commodity prices, etc. As far as we're concerned, that is a status quo, and that will continue indefinitely. Many analysts do not believe that we'll see higher interest rates at least until 2015. But between now and the point where the Federal Reserve actually raises interest rates, we're going to see a really, really interesting phenomenon occur, where we start to move away from quantitative easing and we start to move closer towards higher interest rates. But before, higher interest rates, that's miles and miles down the road. The biggest event that we will see and that will occur in many, many years is the removal of quantitative easing. Today's numbers, this week's numbers actually will give us a much better idea how close we're going to get. Now, what does that mean for us? Well, the dollar tends to weaken under the weight of quantitative easing because QE, quantitative easing, again, prints new money, injects that new money into the economy, so all of our dollars have more dollars to compete with to buy the same barrel of oil and gallon of gasoline, etc. So if we have QE, commodities go up, the dollar goes down. If we have quantitative easing, the stock market also tends to go up. Anybody wonder why the stock market has been so unbelievably strong lately? It's not because of BlackBerry's new phone today. This is the Dow Jones Industrial Average. I cannot remember a time that this is December 31st, beginning of the year. The Dow Jones Industrial Average, December 31st, closed at 12,928. It's now January 30th, 2 months, 60 days, we went from 12,928, we're 13,958. In 60 days, we've moved 1,000 pips to the upside. In 60 days, that's 500 pips a month. If we continue this pace for the entire year, which I'm sure we're not, that would mean the Dow Jones Industrial Average would move about 6,000 points a year. In other words, from 12,000 to 18,000. 18,000 to 24,000, and in 3 years the Dow would be at 30,000. That's the pace that we're at right now with the Dow Jones Industrial Average. That's not normal, and it will not last. I mean, you look at the past, just to put this in a little bit of perspective, and again, this is all quantitative easing. Now, we could say, well, this gap occurred, because the fiscal cliff, and we talked about this yesterday in a webinar here, that, it's, of my opinion, it's a little bit of a personal theory I've had about how the markets work for quite some time, that the market's trend, whether we're in an uptrend or downtrend, is determined by the underlying factors, the fundamental factors that incentivize market participants to buy or sell. You and I, we have different reasons to buy or sell. You might be a short-term trader, I could be a long-term trader, but ultimately we're all encouraged to buy and sell. Well, short-term trading, I guess, is a little bit different. Maybe not. We're all basically encouraged to look at the market one way or the other. Even if we're a day trader, we probably have some sort of long-term opinion as far as which way the market's going to go. My opinion is that Dow, well, the current direction is up. I don't want to talk through the GDP. Oh, 3 minutes ago. Okay. So the market will have this underlying pressure to push it higher or lower. Then the market just looks for a catalyst, a reason, an excuse to go higher or lower. In this case, a fiscal cliff was averted. Not really, but that's what was on the headlines. And the market gapped up. And we've had a lot of pieces of news. In fact, the news has not been that good. Let me show you something I've been working on. On the left-hand side, you see a bunch of green and red lights over here. Under the U.S. dollar, these are all the really big the big pieces of economic news. This does not include ADP numbers, which just came out, initial jobless claims, the minor numbers. No, we only look at the big ones: non-farm payroll, inflation, Philly Fed, University of Michigan, housing numbers, etc. Take a look under the U.S. dollar. Now, if the number beats expectations or shows a general improvement from the previous month, it's green. If it misses analyst expectations or it's a general bad number that shows a decline from the previous month, it's red. Good news green, bad news red. Take a look at the Dow Jones Industrial Average chart on the right-hand side. And this is from the beginning of the year. We drew this line over here. Let's make this a little bit brighter to see here. This line starts at the beginning of the year. Again, the really big numbers. I know it's an imperfect way to look at it, but 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 numbers. 1, 2, 3, 4 of them were green, and 10 of them were red. I don't know what that percentage is. 70% maybe? Around 70% of the big economic numbers released since January 1st missed expectations and/or showed a general decline in the economy. Take a look at the Dow Jones Industrial Average since the beginning of the year. 1, 2, 3, well, we know it's about about 40 trading days, I'm guessing, 20 trading days in a month. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 19, 20, 21, 22, 23, 24, 25, 26. Out of the past 26 actual trading days. 1, 2, 3, whoops, do we have numbers? We have numbers. Out of the past 26 days, we've only had about 4 down days, 5 down days, about 25% of the time maybe. GDP, by the way, wow, that is not good. U.S. GDP, last month, 3.1%. Expectations, 1.1%. The actual number, negative 0.1%. I know I'm probably screaming into the microphone here. Let me move back a little bit. Negative GDP. Again, this is not necessarily technically a recession. A recession from my economics classes decades ago was GDP had to be negative for 2 quarters. So this is just 1 month's revision. It could be positive the next month. But you take a look at the change, 3.1% last month to negative 0.1%. Why has the economy slowed down this much over the past month? Now, for Forex traders, I don't know necessarily if this is very important because we're macro traders. We're concerned about, the overall macroeconomic state of the U.S. as opposed to the Eurozone, as opposed to the U.K., etc. But from my former stock trading days, I always like to go from the macro to the micro picture. I'm speculating at this point. I didn't have a chance to listen to Bloomberg to see what their opinions are. We had the holiday shopping season at the end of last year. Of course, I'm guessing these numbers are seasonally adjusted. They know that the holiday shopping season is going to be bigger, than the rest of the year. I think most retail sales occur during the last couple weeks of the year. But we had, at the beginning of this year, what do we had? We had Hurricane Sandy, and that caused a lot of loss in wealth, a lot of loss in production. I mean, gross domestic product, by the definition, on FX Street's calendar. By the way, here's a link. This is a really nice calendar. Gross domestic product annualized release by the U.S. Bureau of Economic Analysis shows the monetary value of all goods, services, and structures produced within a country in a given period of time. Structures, wow. It is a gross measure of market activity because it indicates the pace at which a country's economy is growing or decreasing. Generally speaking, a high reading or better than expected number seen as a positive for the U.S. dollar, while a low reading is negative. Let's go to a 5-minute chart here. Let's take a look at the actual. Well, that's the Dow Jones. Oh, this is going to be interesting, actually. That's the Dow Jones Industrial Average, which we'll put on the bottom of the screen. This is the U.S. dollar. U.S. dollar Swissy, I should say. Bottom of the screen. Top of the screen. Dow Jones Industrial Average, bottom of the screen. Take a look at the reaction. The dollar's going down and stocks are going down. I mean, I know there's a green candle on the Dow right now. I found that interesting, by the way. I chuckled when it said structures because I'm thinking of Hurricane Sandy, how maybe part of the components of today's negative GDP number will be reversed because, again, the GDP is the monetary value of all goods, services, and structures produced within a country. A lot of people were out of work as a result of Hurricane Sandy. And a lot of homes were destroyed. Well, those people will get back to work. And I'm not guessing they lost their jobs. I'm thinking they just took time off because, of the damage. And their homes that were destroyed and the businesses that were destroyed. Think of the businesses that lost revenue because they were literally underwater. I saw, actually on a personal basis, how bad it was here in New York. But those businesses will recover. Insurance companies will inject that capital back into the economy. Those homes that were destroyed will be rebuilt. So today's GDP number, it's bad. It really is bad. I mean, the country's economy, the U.S. economy does not revolve only around Staten Island, New York. But I think that this number might be a little bit exaggerated to the downside. I don't know by how much. I mean, I'm not an economist. Maybe a tenth of a percentage point, maybe half of a tenth of a percentage point, a fifth of a percentage point, who knows. But I think that maybe we will see a little bit of a bounce back. If nothing else changes in the U.S. economy, we'll see a little bit of a bounce back because those homes that were destroyed will be rebuilt. Those businesses that were out of business, well, they're going to stock up on food and supplies and all that stuff, and they're going to open their doors again. And, if anything, the insurance companies are really going to take, maybe the brunt. Of course, insurance companies never really take the brunt of anything. But the insurance companies will compensate these businesses. So, perhaps it's a little bit exaggerated the downside, but my concern is this. You see, CEOs of Fortune 500 companies all around the country, they watch these numbers very carefully. I mean, there's absolutely no way, if you work in finance at all, that you would not be aware of this number. And the Federal Reserve is meeting today, and later on today, and they're certainly going to be very well. I don't know that they're going to change their decision. I'm sure the decision is already down on paper. But I think that the decisions made by businesses, whether to expand manufacturing, to hire new employees, all of that could be stunted by this number. After all, if we run our own company, we say, well, I have a certain amount of money in the bank, and I have a certain amount of employees, and we're not talking about the higher healthcare charges this year, we're not talking about the higher taxes, none of that, we're just talking about today. Based on today's numbers, is it better for me to expand? Well, actually I think it is better during a recession, during a down economy to expand, to invest. But that's a very bold way to go about doing business if you don't have anything at stake. The fact of the matter is, if we have a real payroll to meet every single month, businesses might want to contract. Not to contract, but to hold back, not to hire. If businesses that maybe yesterday were considering hiring a couple new employees and now they're not because of this number today, that in turn could have a snowball effect to the economy. So there's really no good news from a negative GDP number. Now the question is, which way do you think the euro dollar and the pound dollar will move as a result of the GDP number? It's a great question. First of all, let's talk about the US dollar currency on itself. The US dollar currency moves under the expectation of higher, lower interest rates. This is a negative number. But we already have zero interest rates. So the next step is, the question we really have to ask ourselves is, how much longer will we have quantitative easing? This builds a case for more quantitative easing. By the way, this is not the only number that was just released. Calendar personal consumption expenditure 1.2% versus the prior month's 1.6%. I don't know what the expectation was. But look at the core PCE, which excludes food and fuel. It's the more volatile components of the inflationary index. This is also a bad number, a disappointment. Last month, 1.1%, expectations 1.0, today's number 0.9. Really important, because the Federal Reserve has said the number one reason, I'm paraphrasing, and we're going to get better information later on today. But the number one factor that the Federal Reserve is looking at, in my opinion, I think, is inflation. More quantitative easing, we think, would only be good for employment. More quantitative easing, we assume, would be good for GDP. What we do not know, or what we're concerned about, is that more quantitative easing is going to be bad in terms of, it's going to create more bad inflation. I like to say there's two kinds of inflation, good inflation and bad inflation. Good inflation is if we work for Dell Computer and the economy starts to recover and a lot of people go out and they decide to buy a new laptop computer, and Dell sells more computers, therefore the price of the computer goes up, therefore they can hire more people and they all get health care and they all get 401k plans, and everybody tends to benefit from that. That's good inflation. When prices go up as a result of growth. In other words, when inflation goes up while GDP goes up. In fact, I didn't have a lot of chance to work on this, but I have this little theory that if you take the inflation number divided by GDP, that would give you a better true sense of where the economy is. Because if prices go up, if inflation goes up and GDP goes up, or in a best case scenario, GDP goes up and prices actually go down, or don't go down but stay flat, that's a strong economy. What we have is bad inflation right now. Bad inflation is inflation that goes up, and not as a result of stronger economic conditions, but rather as a result of a diluted dollar which was created by quantitative easing. That means we're not making any more money, our salaries are not going up, we're not getting any more jobs, but the price of food is going up, the price of gasoline is going up, the price of many commodities and pretty much everything is going up, and we say to ourselves, hey, I can't even afford as much as I used to be able to afford. I'm not making as much money as I used to make. Not as many of us are working as used to be the case. That's bad. And I think that's what we're seeing right now. I mean, you take a look at, and by the way, the PCE, personal consumption expenditure, that's the Fed's inflation. They don't really watch the CPI as much as they used to. They've invented this new thing called the PCE. So you have GDP at negative 0.1%. on a quarter-over-quarter basis. You have PCE at 1.2%. Now, PCE went from 1.6 to 1.2, but GDP went from 3.1 to negative 0.1. GDP in 1 month's revisions went down 3.2%. Inflation went down 0.4%. That's a factor of 8 to 1. GDP, and I know this is probably not an accurate way to consider these numbers, but if you look at just the numbers in their face value, GDP went down 8 times as fast as inflation went down. The amount of money that we make went down 8 times as fast as the amount that prices went down. Prices actually went down very little. Economists also say, well, we could also look at the PCE, the core PCE, which excludes food and fuel. 0.4% decline on all prices, 0.2% excluding food and fuel. So food and fuel actually went down a little bit, maybe more. So getting back to your question, in terms of first the US dollar, we're further away from higher interest rates. It builds more of a case because inflation has gone down. It's more of a case for more quantitative easing. So long-term trend in the dollar Swissy, I think, is down. I don't think anything has changed. I don't know if today is necessarily, as far as picking a day trade out of this, that's kind of tough. I mean, if the dollar was going to go down, it would have gone down already, obviously. But the long-term trend in the dollar Swissy is to the downside. There's no reason. Here's a daily chart. There's no reason for me to believe that this is going to change. But I don't think that this is the best trade. And your question is regarding the euro dollar and the pound dollar. We have to go through the same analysis with every other currency. Go back to our economic chart here, which is right over there. What I like to do is to look at each economy on its own. Let's take a look at the U.S. A lot of negative numbers. Today's GDP number will be negative. Then we have personal income tomorrow. We have a Federal Reserve meeting later on today. Non-farm payroll on Friday. ISM manufacturing. But even without knowing what those numbers will be, obviously there's a lot of red. In the Eurozone, there's a lot of green. Last week, we had 4 big numbers. 2 of them, I think, are the biggest numbers, the ZU and the IFO. The ZU is the German, I always mix them up. Is it the German confidence number, and the other one is investor expectations? And they were both good. They were both really good, actually. We had a CPI number, actually 2 CPI numbers. The Eurozone's weird, though. They report CPI twice a month for some reason. I'm not sure. There's a revision, I believe. But the GDP number was good. Yes, unemployment and PPI and industrial production, not a perfect case. The Eurozone numbers definitely do look better than the UK numbers. That's for sure. I'm definitely, convinced that the euro has been stronger than the pound. That's for sure. So we have to ask ourselves the question, well, in terms of the trade, take a currency you think that's going to go down, take a currency you think it's going to go up, and put them together. I think the dollar, long-term trend to the downside, euro, long-term trend to the upside, put them together. The euro dollar, here's a chart, euro dollar daily charts, there we go. There's no reason for me to believe that this trend will stop. Now, it is very, very overbought. So, as far as the long-term trade is concerned, who knows how long this is going to last. But there's no arguing with this trend. This is a euro-dollar daily chart. This is up. The best way really to get a gauge of the strength of the trend is actually just look at the charts. I mean, as much fundamental analysis that we can throw onto this. Take a look at this chart. This is amazing. It's amazing how much of a divergence there is. We had a range-bound market at best with the pound dollar. Let's compare and contrast these. Pound dollar is at the bottom of the charts. Euro dollar, top of the chart. Notice any difference? Big difference. take a look at the fundamentals on the left-hand side of the page. This is actually kind of a nice way to, cool way to think about it. You know, you have the fundamentals on the left and the technical analysis on the right, and they match up. Dollar fundamentals, almost all red. To answer your question, do you expect the Federal Reserve to increase interest rates in the near-term future? I would say absolutely no. We'll know later on today when Ben Bernanke speaks, Chairman of the Federal Reserve, but you know, I'm guessing 2015. And in addition to that, I don't see that there's a lot of reason for the Federal Reserve to take away monetary policy, meaning quantitative easing. Now, so that would lead me to believe that the dollar is going to go down. Dollar goes down, what is the better trade? To short the dollar against a strong euro with good fundamentals? Or a weak pound with relatively negative fundamentals? We don't have as much news in the UK to base our decision, but almost all the numbers we have right now are red. You know, fundamental analysts, the real fundamental analysts will say, well, the unemployment level in the Eurozone was bad. The employment level in the UK was good. Maybe employment is a forward-looking indicator. Maybe employment has to improve before the GDP improves, or the PPI, the industrial production. Maybe those numbers will follow employment. Or maybe on the reverse side, maybe the Eurozone economy is turning back to the downside, and the unemployment level is the first to go. Maybe when more people lose their jobs, that will begin to affect GDP, CPI, the ZOO, consumer confidence, etc. I don't know. That's microeconomics. That's beyond me. But nevertheless, to answer your question, in terms of euro dollar, pound dollar, I think that today's numbers just build more of a case for the euro dollar to go up. Pound dollar, I don't have any opinion. I mean, you know, I would say based on the chart, I think it has a better chance to go down than up because we have, you know, we've just recently broken this long-term trend, this long-term range-bound pattern, and it looks like we're more of a trend to the downside, but it's not a clear-cut trade. You know, it's not a high probability trade. You know, you short the pound dollar, I'd say, let's say you have a 55% chance of being right. But if you go long the euro dollar, I'm making up the numbers obviously, maybe you have a 70% chance of being right. So, and you want to, you know, when we're trading live accounts, we want to place the trades in those accounts with the highest probabilities of success. Let's talk about gold. How can I forget about gold? All right. So let's reorganize here while we have a few minutes to go. Okay. So this is the dollar Swissy. On the top left-hand side, that's a Dow Jones Industrial Average. On the top right-hand side, these are all 5-minute charts. Take a look at gold. Why would gold go up so much? I think I just lost my chart here. As I reproduce a chart, XAU, I'll give everybody a chance to think about this. Why is gold going up? Well, when the Federal Reserve prints new money that we all know of as quantitative easing, dilutes the dollar. Our dollar has less buying power. We can afford to buy less oil, less cotton, less commodities. Gold is a commodity. In fact, gold is the most perfect way, the closest thing to a perfect way. Nothing's perfect. But the closest thing to a perfect hedge against a falling dollar. If we have $100 in our bank accounts in 2008, and that we are at the time we're able to buy with $100 how many gallons of gasoline? Well, $100 divided by $1.84. Fact. So now gas is $3-4 a gallon. We still have $100 in our bank account. It's the same amount of money. It buys a lot less gasoline. To protect ourselves against a falling dollar, so we know we will still be able to buy a gallon of gas, the same amount of gallons of gasoline in the future, or stocks, or whatever it may be, we buy gold. Today's numbers, and it's great point pointing out gold, because we didn't really have a lot of reaction in the dollar Swissy or the Dow so far. But the fact of the matter is, because today's GDP number was so bad, because the PCE, the inflation number, also showed a decline, it's more of a reason to expect more monetary policy, more quantitative easing, more of a reason to expect the Federal Reserve will not raise interest rates as far as maybe 2015. More quantitative easing. We had QE1, QE2, 3, now we're at 4. Maybe we'll have quantitative easing. I mean, can you imagine if we have quantitative easing all the way for the next 2 years? It'll be 6 years of quantitative easing. We're talking about the purchase of anywhere between, QE2 is about $75 billion a month of long-term treasuries. We're now at $80 billion a month. I think 80 or 85, 40 billion in the form of long-term treasury bonds, 40 or 45, I forget which is which, in the form of mortgage-backed securities. You extend that out, $75, $80 billion a month of new money being injected into the economy, times 12 months a year, times 4, 5, 6 years. Trillions and trillions, maybe the number is even bigger than a trillion. A massive amounts of money that's injected into the economy. That's how much less each one of our dollars is worth. We want to make money from this. I cannot believe it took me so long to come to realization, but you got to own stocks. You got to be long gold, because over the long term I'm talking. Right now the stock market is very extended to the upside. It's actually, I think, kind of a risky bet. But the fact of the matter is, the Federal Reserve is manufacturing inflation, because they're hoping as prices go up, corporate earnings go up, the house prices will go up. As my house price goes up, now it won't be underwater, it'll be above water. I'll be able to refinance or maybe sell it and make a profit. My stocks will go up. I'll be able to sell those stocks and take profits and open a new business, reinvest in something else. They're manufacturing inflation because they're hoping that if the Federal Reserve in some way gives us all a little bit more money, that we're going to be able to take that money, put it back into the economy, and then the economy is going to start to grow on its own. It's as if, listen, here's the analogy. The car doesn't start. We press on the gas, it doesn't start, and it still doesn't start. What happens when you press, this is for those of us that remember cars before fuel injection. When we actually had carburetors. If you pump the gas too much, what happens? You flood the engine. It's possible to put too much gasoline in a car in terms of, flooding the engine. That's the risk that we're running, but the Federal Reserve says no. It says we just need to stoke this fire as hot as it can possibly be, because then eventually the fire will want to burn on its own. I guess that would be a better analogy. That's what the Federal Reserve is hoping. What I think is they're flooding the engine. They're manufacturing inflation, but this inflation is actually making things more difficult. Because where do I spend all my money? Gasoline, food, clothing, that kind of stuff. Very small amount of my working capital on a day-to-day basis, benefits from stock prices. We all have retirement money, but most of our capital is spent on inflation. So the Federal Reserve is hoping they manufacture inflation that will create an economy. I think that they're manufacturing inflation and they're doing it to such an extreme to actually slow down the economy. I think today's negative GDP number is just a result of that. Nevertheless, regardless of how we think, we can't ignore the facts. And the facts are negative 0.1% GDP, PCE declining as well. Where's my economic calendar? PCE 1.2%, core PCE 0.9%. All numbers we've discussed today were less than expected, less than the previous month, showing a general decline. We can attribute it to seasonal factors. It's been really cold in the Northeast. We had a hurricane here, Hurricane Sandy as well. But that's just one piece of the country. We have a lot going on. So as far as the U.S. dollars trade is concerned, I think that there's not a lot of reason to believe that it's going to go up over the long term. As far as putting together a day trade, well, that's a different story. We'd have to look at a lot more specifics of that actual event, that actual period of time we're looking for the trade. Nevertheless, it's one big number. We have later on today Federal Reserve. Later on after that, we have personal income tomorrow, non-farm payroll numbers, and ISM numbers at the end of the week. A lot of data to digest. Take all that in, plan your trade accordingly, and hopefully, if we do our homework, we'll find the trade with the highest probability of success. I'm out of time. If you have any questions, you can contact me, www.forexlounge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see the calendar because we have a lot more to talk about. Again, we thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside FX Streets.